Welcome, everyone, and thank you for joining us. My name is Brian Rowan, and I'm an Associate Director in the UK Transfer Pricing team. Today, we'll be discussing HMRC's recently published consultation on the International Controlled Transaction Schedule, or ICTS. The consultation represents one of the most significant developments in UK transfer pricing compliance in recent years and provides an important indication of HMRC's future approach to transfer pricing risk assessment. It's worth noting that this is still in consultation and therefore subject to change. To help guide the discussion, I've been joined by colleagues from our transfer pricing team. We'll begin by discussing the basics of the ICTS itself before exploring how it fits within HMRC's wider transfer pricing compliance strategy, and then examining some of the practical and technical challenges that we believe businesses should be considering. So, Jeremy, for those who may not have had a chance to review the consultation yet, what is the ICTS?
Thank you, Brian. Hello, everyone. My name is Jeremy Brown. I'm a transfer pricing partner here at Forvis Mazars. So I'm going to talk today about what is the ICTS, who has to do it, and when does it have to be done. So at its simplest, the ICTS is a proposed annual reporting schedule that will require in-scope businesses to provide HMRC with information on their cross-border related party transactions and dealings. HMRC has talked about introducing such a requirement for a number of years, and as part of wider transfer pricing reforms, they indicated that they will be implementing this. A couple weeks ago, on the 16th of June, HMRC published a consultation on that with details on exactly what they expect this to be. So the objective here is for HMRC to collect standardized information on international controlled transactions in a format that they can then analyze electronically. So rather than waiting until an inquiry begins to gather information, HMRC intends to gather information from taxpayers and businesses as part of the annual compliance process. And in doing so, we think that HMRC hopes to gain a more consistent view of transfer pricing arrangements across the population. And it's quite an ambitious proposal in terms of what we're seeing in UK transfer pricing today, on account of both the volume of data that we expect will be requested and all the transactions that may be captured. So what will be captured or might be captured, and in what form? So the consultation indicates the reporting will be required for a wide range of cross-border related party transactions, goods, services, those involving intellectual property or intangibles, financial transactions, business restructurings, and it will also apply to dealings with permanent establishments. And the indication of this will be in a table format, and there are different rules based on the consultation for different kinds of transactions, whether it's sort of a general category like services, or whether it's a business restructuring or a financial transaction. But sort of for that general category, the types of information that we'll need to provide are things like who is a tested party, indicate if that's relevant, has been applied, what markup has been applied, the total expense or income impact on the profit and loss account, as well as details on the counterparty. And then for something like a profit split, it asks for what's the profit or loss being split, what profit splitting factor has been applied, these sorts of things. HMRC has produced a draft template for all of this, which goes into all the types of things that might need to be reported for different types of transactions, and that can be seen there. And so looking at this, clearly the objective is not just to gather information for the sake of it, it's to create a data set that HMRC can then use for automated risk assessment. And it's an important distinction because it helps explain many aspects of the design here. So the information that we expect to be requested based on this is been structured in a way that allows businesses to be compared against one another, to compare transaction types against one another and across industries, to allow year-on-year monitoring, and also, I think, crucially, enable HMRC to identify outliers. So businesses or transactions or outcomes that differ from what they might expect, and also what they might expect based on all this information that they're going to receive. They'll be able to go in and do some benchmarking for what they expect to see. And so in essence, the ICTS here is designed to make transfer pricing risk more visible. So then who's going to have to do it? So the ICTS will have to be done by any business that is in the scope of the UK transfer pricing rules. A couple points here. So that means that small and medium-sized enterprises, so SMEs, will be exempt. In addition, any transaction covered by an advanced pricing agreement or APA will also be exempt. And there are transaction volume thresholds, which is defined as the impact on the P&L. And so those businesses that are within the scope of country-by-country reporting, so group turnover of greater than 750 million euros, that threshold is £1 million, which aligns with the UK local file requirements in terms of disclosure of transactions. And for those groups that are not in CYC, that threshold is £100,000. A point on this is that transactions that are relevant to these thresholds, transactions that are of the same type, which is to say, have been analyzed using the same transfer pricing method, must be aggregated and not netted. I think this is quite important because you could have a business that has lots of small transactions of a similar type that are below 100,000, but added together, they're above that threshold and then need to be reported. And then lastly, when does it come in and when does it need to be done? So the current intention is for this reporting requirement to apply to accounting periods beginning on or after the 1st of January 2027, with submission to HMRC by the time of filing the tax return in 2028.
Perfect. Thank you, Jeremy. And then, Dan, could you tell us how taxpayers should be thinking about how they complete the ICTS?
Thanks, Brian. Yeah, so I think that in terms of the how taxpayers should be thinking about completing this ICTS, it really does depend on where you sit in the market. So as mentioned previously, the transaction thresholds are different depending on the size of the taxpayer. So at one end of the scale, you're going to have client taxpayers who are already producing local files on a regular basis, in which case they're already going to have much of this information to hand. Therefore, the additional compliance burden will be kind of fairly minimal. They should already have processes in place to collect this information. I think the big change is going to be for taxpayers who are above the SME threshold in the UK, but below the annual requirement for needing to produce annual mass file, local file documentation. Probably starting now, taxpayers who fall within that bracket should really be looking at what data is available and how easily they can actually access this information. And also as well, maybe having a bit of a dry run doing this before this year end, in case there are any gaps in which would mean that we'd not be able to complete a tax return next year. Because again, all transactions from 1 January 2027 are going to have to be reported in some way, shape, or form in this template. So there's a big systems challenge there and a big data collection challenge. I also want to talk briefly about banks, as there are two specific forms that are only relevant for banks and other qualifying financial institutions. The first one is section A1, I beg your pardon, AI. This section basically is a segmented financial, however, in quite a prescriptive format. The way it's currently drafted, it appears to suggest that banks need to disclose their operations and businesses in line with the BAL 2 framework. So this would be different types of businesses that banks might operate, be it be wealth management, investment banking. There are various subsections within investment banking. So, for instance, fixed income might have to disclose separately. Um, this would be again. There's some nuance around this effectively because a lot of banks are pretty much every bank is organized slightly differently, and even within those frameworks, you're going to have a certain amount of overlap. So the key example I can think of is that fixed income. Within fixed income, you have foreign exchange. Foreign exchange income can appear in private banking. It can appear in your derivatives trading. So I think a bit more thought is required around that, and I think banks are going to have to think quite carefully about how they present the information and to what extent they can rely on existing management information. As what you don't want to do is effectively have to present a separate view of your business from how the business is currently managing itself. The other element to look at is section BI, which is around about it's basically additional information required on loan relationships. So this is additional tier one and tier two. So when we've looked at this schedule, much of this information for banks should already be available in their Pillar 3 disclosures, which they currently provide to the PRA. However, it appears to be more granular in that it's actually requiring details of every single instrument and including some certain data fields that aren't typically required by the PRA. So from a data collection perspective, how you fill this in, I guess banks are probably, if you're the tax department, most tax people aren't natural alternative tier one capital experts. I think probably the first thing you need to start doing is speaking to your treasury colleagues, your capital management colleagues to see what information is available. But certainly as part of this consultation, I think what a lot of banks will be asking, and certainly myself, is a bit more clarity about what information is actually needed. And, are there any exemptions, for instance? Because as currently drafted, when I look at the schedule, it does appear to ask for all tier one instruments and all tier two type instruments. I would probably question if there's no intercompany relationship there, do we really need to fill that in? Because again, the purpose of this is to gather information for transfer pricing purposes. And a number of UK only banks who don't have overseas operations will be issuing these instruments into the market, and there will not be a related party on the other side of this. So one thing that I will be specifically asking is get some clarity. Does that mean that we're covered by the UK to UK exemption and we don't need to fill that in? I think that would be quite positive for taxpayers if they don't have to fill this in, because it's again, there's no transfer pricing risk in that instance. But that's quite specific for banking. Again, there's a lot of questions to be asked, and I'm sure we'll get some more feedback from HMRC in time.
Perfect. Thank you, Dan. Gabrielle, could you talk to us about why HMRC has taken this approach with the ICTS and maybe speak to similar approaches in other jurisdictions?
Sure, thanks, Brian. Hello, everyone. My name is Gabriel Mayor, and I'm also a partner in the transfer pricing team here in Forest Mazars. Well, why? Why now? Why this type of form? And what can we expect in the short, medium, and long term after an introduction of this type of form? So I think the first thing that I could say is that similar forms as the ICTS are not new in the transfer pricing world. Some countries have something of this sort for the last 25 years. Even countries in the region have had it for a number of years, the likes of Germany, Spain, etc. So why? The main reason that drives this is more transparency. And more transparency for two main reasons. One, to make it easier for HMRC to identify which entities to fiscalize, to core entities to be more effective on their inquiries, and to make these inquiries more cost effective as well. And two, to motivate behavioral changes in some taxpayers that might have some TP models that are on the riskier side. A good indication that these are the motivations for this introduction came when the ICTS was first introduced in last November's budget. It came accompanied by a tax impact table of the additional revenue that HMRC is expected to collect from the introduction of the ICTS, which, bear in mind, is not an introduction of a new tax, it's just introduction of a new compliance requirement, right? And so even on the first year, so the year, as Jeremy said, this as it stands right now, it will apply for fiscal year starting the 1st of January of 2027. But even for fiscal year 26, they're expecting to collect an additional 50 million in taxes, and all the way up to 2031, where they expect to collect 350 million on an annual basis of additional taxes. So all in all, in the first 5 years, they're expected to collect 900 million. And in this tax impact table, they said that they expect to collect that on those two grounds. One, behavioral changes, and two, more effective, both cost-effective and result effective inquiries. If you take all of this and you also put in the fact that the same day that this new consultation on ICTS was published, less than 12 hours later, a new consultation on PDCF was published as well. And for those of you who don't know what PDCF is Profit Diversion Compliance Facility. It's a facility that was introduced a number of years ago in the UK for entities that believe that there might have some transactions that might result in some profit diversion outside of the UK. So it's a facility for them to voluntarily disclose this and analyze it in a way that is with HMRC that is faster than the regular channels and that excludes some certain of the penalties that would happen otherwise, right? And in this new consultation of the PDCF, the extent before was just focused on transactions that could result in profit diversion. And now it has they have expanded this to include any type of transfer pricing transactions. And the way this PDCF facility works is basically like a self-inquiry. You do the inquiry, so HMRC is not there when you do inquiries, and when you present the results, then you begin to discuss your approach and to see if HMRC would accept that approach, right? So having the ICTS and at the same time this consultation with PDCF is just an indication that there is an expectation that there will be more inquiries in the near future and the midterm as well, more effective because now they will have the ability to compare not only same transactions between entities, but same transactions in different industries, and then go or focus on those where they believe they will have a high level of assurance that they will get an adjustment. And for those that they're not sure, they can do this PDCF, they can send a nudge letter to those companies to do this self-inquiry through the PDCF facility and result in additional revenue. So that is the reason why. And as we have seen in other countries, this is how it usually introduction of similar forms have been accompanied by an uptick in the tax stories increase.
Perfect. Thank you, Gabrielle. And then, Luciana, how do you see the ICTS interacting with the existing transfer pricing documentation requirements in the UK?
Thanks, Brian. As mentioned already, many businesses are already preparing master files, local files, benchmarking studies on an annual basis, albeit at the moment this documentation is not required to be submitted to HMRC unless requested. So the ICTS introduces a separate reporting framework with a different objective alongside an already established compliance framework in the UK. So therefore, one of our concerns is the interaction between the ICTS and these existing documentation requirements. At present, the relationship between these elements are not entirely clear. So our transfer pricing documentation is designed to explain and support the arm's length basis of transactions. The ICTS is intended to provide structured data for HMRC's risk assessment processes. Whilst the objectives are related, they're not identical. So it remains unclear how HMRC will assess differences in segmentation, aggregation, or presentation across these reports. For example, what happens if segmentation differs from a benchmarking study or information is presented differently from a local file? Will differences in presentation be viewed as risk indicators? And how will HMRC distinguish between genuine transfer pricing risk and differences that arise naturally because the ICTS, local file, and benchmarking analyses are designed for different purposes? So we would definitely welcome greater clarity from HMRC's expectations on these. Thanks, Brian.
Thank you, Luciana. And so we've discussed that this ICTS regime will be heavily focused on data and reporting. Gabrielle, could you maybe give us some oversight into the challenges of aggregation and segmentation?
Sure. So as it stands, the ICTS is demanding that the information is reported not on policy, but on end result, which means that if you have a policy of 10% on a number of transactions and other transactions you have at 5, it's not enough just to say, well, 5 for, I don't know, distribution and 10 for manufacturing. Is that you have to show, okay, how much profit do you obtain? What was your markup on total cost in your manufacturing activities? And what was your return on sales, for example, in your distribution activities? And if you have all of those aggregated in a P&L, that will mean that you will have to have an effective segmentation of the revenues, of the costs, and most importantly, the one that gets the biggest headache of the SG&A, of the operating expenses. So For some entities, or some taxpayer, depending on the systems that they have, this will be a very straightforward exercise. But for others, especially large entities, large groups, which have different systems that need to talk to each other, or transactions with a number of countries around the world, which might have different type of policies, etc., this could become a big headache. And for some, as it stands right now, it is very difficult, if not impossible, to achieve that information. So then comes the creativity. So if you cannot, what's the closest you can come to complying with this? And that's also part of what we are putting in our consultation on the questions that we want to clarify with HMRC, that this cannot be a blank statement, that it has to adapt to the different realities of different groups. So yeah, what is clear is that one of the largest complications that will come out of this is data collection for all clients, because most of this information, in theory, you should already have it in, as Susanna said, already in your documentation. That being said, collecting in the way that HMRC is requesting it might be a larger push.
Perfect. Thank you, Gabrielle. And then I guess before we kind of close out on this section, I wanted to discuss some of the common questions from clients off the back of the ICTS consultation. And so I guess the first question from that is, for a client who is already preparing a local file annually, what should they consider in relation to the ICTS?
Brian, shall I take that one?
Yeah, sounds good.
So I think, I mean, I suppose the first thing is, what is in the local file that you prepare currently, and how does that look? And comparing that really side by side with this draft ICTS template and a requirement. I think that, it's really in the details of, certainly for groups that are above the CYC threshold or not, but are preparing an OECD style local file that has details on all the types of transactions and quantum, counterparties, etc. I think a lot of that information presumably will be there and possibly can be ported across to the ICTS. I think the challenges that will come, it's not, but I don't think it's necessarily going to be a one-for-one transfer across. Some of the challenges around aggregation and segmentation that Gabrielle just talked about are one of those that will need to be thought about. I think there's some additional granularity in the ICTS that I wouldn't normally expect to see in a local file. Things like the impact on the P&L, for example, some of the stuff that banks will have to do around capital reporting would not normally be on a local file. So these kinds of things will need an additional look. I think that the current ICTS template as well, one of the things that it has a lot of drop-down menus of sort of binary yes/no questions, which are, again, not kind of normal local file type things. And this is all around preparing things in sort of a standardized format, but those will need some attention. So there's certainly going to be additional work going into this, even if you are doing a very good comprehensive local file today. And then, but I think the bigger gap certainly is if you're not doing that per sort of OECD standards, if you're not above 750 million euros in doing that, this is going to be an entirely new exercise that has to be done. So again, depending on where you are, could be a lot, could be a little, but certainly there will be some to do.
One more thing just to add to this. One of the most important things that will come into play in the ICTS is that there's conciliation between the ICTS, all the figures in the ICTS, and the figures that you have in your report. Meaning that if you're saying that you had purchases from an entity in France for X amount, that same amount is the same amount that you use when you're doing your segmentation and calculating your cost of goods sold for that segment in particular of what is the profit that you obtain with that entity in France. So all of that needs to be aligned, which is not something that usually, as the local file stands right now, is necessarily in every local file.
Perfect. Thank you, Gabrielle. Thank you, Jeremy. I guess the second question then that we've kind of seen a lot is, as a client, what do I do now? Ahead of the introduction of the ICTS, what should be my kind of next steps? Jeremy, if you could speak to that.
Sure, Brian, thank you. I mean, there's a few things. So just in terms of a timeline perspective, we're in the consultation now. Consultation closes end of July, but with the intent for this to start 1st of January next year, we expect that HMRC will turn this around pretty quickly in terms of the consultation. We think we should hear from them maybe in the autumn with sort of a final set of rules and regulations. So the first thing is just to keep an eye on that. The second thing is think about how prepared you are for this. And there are a few buckets to that. One is from sort of a policy and governance perspective. I'd certainly say now is a good time to revisit transfer pricing just generally in your organization. And related to that, think about, for example, could an APA be a good choice? Could the new expanded PDCF, Profit Diversion Compliance Facility, could that be something worth thinking about as well? So definitely some stuff around that. Two is around, as Daniel talked about, around data and systems readiness. The dry run, I think, is a great idea of, are you actually ready to extract all this data? What's it going to look like? What are the challenges? And making sure you're sort of data and systems ready. And then third is around sort of stakeholder communication and readiness in the sense of, does finance know about that this is coming, that they're going to have to gather all this information and probably do a lot of analysis around that, the wider tax team, CFO, FD, IT, all of these different internal stakeholders who will have an interest in this and sort of ultimately be involved in preparing the ICTS, start to communicate with those individuals, those groups, and start to really sort of pull together a plan for this.
Brian, one thing that I wanted to say before I close is that the main, I guess, highlight of the ICTS is that it's no longer enough what you say, is what you can prove. So if you say that you received the service and you got this benefit, how can you prove it? How can you prove that the service was actually rendered? And how can you prove that the benefit that you're obtaining from that was actually obtained? If you're saying that certain functions are in a particular jurisdiction, and that's why that jurisdiction is the holder, the owner of the intangible, or the entrepreneur, etc., how can you prove that those functions, that governance is actually done, that those risks are actually managed and borne there, right? Is it that a collection of emails? Is it that board meetings? So it is a much wider exercise than what we have seen in transfer pricing, at least in this country. So this is something to bear in mind when connecting all these pieces together.
Perfect. Thank you so much. And thank you to all for presenting today and for your contributions. And for anyone watching and listening, thank you for joining us today. As we've discussed, the ICTS represents a significant evolution in HMRC's approach to transfer pricing compliance, and it reflects a broader move towards data-driven risk assessment and more targeted inquiries. While many aspects of the proposal remain subject to consultation, it's clear that businesses should begin thinking about the implications for their transfer pricing framework, data governance processes, and reporting capabilities. We hope today's discussion has provided a useful overview of both the opportunities and challenges presented by the proposed regime. As the consultation progresses, we expect further dialogue between HMRC, taxpayers, and advisors, and we look forward to contributing to that discussion. If you would like to share any comments in relation to the consultation, we welcome the opportunity to do so ahead of the consultation deadline on July 31st. If you have any questions about the ICTS, its potential impact on your organization, or would like to discuss your readiness for these changes, please do get in touch with your usual Forbes Mazars contact. Thank you again for your time and your interest, and we hope that you found today's session informative and valuable. Have a great day.